Okay, so I'm just going to start our recording today. So, good afternoon, welcome back, and I'm just going to share my screen here, and we'll get back into things here. All right, so just again, a reminder, our quiz on Thursday. And that's 15 multiple choice. Guess I don't need a period there. Multiple choice questions, and that's 13, or chapters rather. Chapters 13, 14, and 15. Okay. And then, so today we're going to start 17. We might even get into 18. So there's a few chapters to go, but we don't cover the entire thing on some of the chapters. Some of them I think are things that aren't brand new for you, so we'll move pretty quickly through those. Okay. And again, well, it's going to be a bit of both. So it's the same as in the past. It's there's lots of terminology questions in some of those chapters, particularly chapter 15. So um, certainly everything's fair game. So 15 is a lot of terminology about IPOs and secondary offerings, and so a lot of things to know there. Okay, no lockdown. All right, sorry, there is lockdown on this one. Sorry, so you do need a lockdown browser. So you do need to do that. Guess that's. You can write the quiz anytime that day, I think from 6 a.m. to 11 p.m. So whenever you have, you have an hour to do it. So to give yourself a good hour, find an hour in the day, and then go ahead and do your quiz. Okay. Yeah, so lockdown browsers is on it. You have all day, 6 a.m. to 11. You have an hour to do it. 15 multiple choice. I think the last multiple choice is well, spoiler alert, it's a weighted average cost to capital, so I think that's 2 marks. So keep that in mind when you're doing the quiz. There's that last question is worth 2 marks, and the others are all weighted at 1 mark. But there's a few more calculations, so it's worth a few more marks. Is this the last quiz? Yes, it is. So the good news is this is the last quiz, and then you have the final exam to look forward. Okay. So, all right, so we can celebrate tonight that we've had, or well, I guess not tonight. Let's do it on after Thursday and celebrate the last quiz, and then we have the term exam, or it's not the term exam, the final exam uh, is coming up, and then that'll take us to the end. Okay, any other questions on the quiz or anything else before we get started today? So we're going to get into chapter 17. We're going to talk about dividends today. So you probably heard of dividends, but we're going to go into a little more detail probably today. And I'm just going to find the slide here. Will we have any classes? There's an exam, or sorry, there's a review session planned. I think Jason Evans is doing a session, so he's going to share the link when he does it. I don't know that it's recorded, but if he's going to give me the time, and I'll post it and post the link when we have that. Okay. Like I say, we don't have a lot of time for review, but hopefully we can find some time, either inside or out of class. So if his time doesn't work, and we'll find a time that works a little better then. Okay. Again, on your quiz, you can use the standard, index card size calculator, assuming you have a normal financial calculator. You can use a piece of paper about this size, one side only, for your formula sheet. And so for this quiz, you're allowed to use that resource and, of course, your calculator. All right. Okay. So let's dive into dividends. And again, there's a lot of I would say, um, if you want to call it theory information, or if you just want to call it, terminology, whatever you want to call it. There's some calculations, but this is your last assignment, so that you do get to do some calculating in this chapter, but there is a fair bit of terminology and just understanding some concepts and terms. All right, so we're going to look at different dividend types, and from your accounting days, you probably remember a stock dividend and a stock split and things like that. So we're going to talk about those again. Some issues and things around dividend policy in general. Difference between a cash and a stock dividend. We're going to look at share repurchases, so that's been pretty common lately. Instead of a special dividend, which we'll talk about, companies are using excess cash to buy up their own shares and bringing them in and canceling them. Okay. And we're going to talk a bit and contrast, a share repurchase versus dividends. And we'll see that in a world without transaction fees or taxes, which of course we don't live in. We'd be indifferent as a shareholder. Okay, so we're going to talk about just again some of the things around dividend policy, about the messaging it sends, about the clientele effect. Some people like dividends, or grandma's retired, she's counting on that dividend check every quarter to help her pay for her vacation or buy her groceries. And whereas if you're 30 years old in your career, you're starting to save money, hopefully, and you're investing it, and you're more interested in capital appreciation as opposed to receiving a dividend. Okay. All right. All right, so we'll just start with the basic cash dividend. So when you took financial accounting, you would have seen this in the equity section. The board of directors declares a dividend. There's a dividend date. So the dividend's declared, and then there's a date of record, and then there's the actual payment date where the check or the deposit goes out. All right, extra cash dividend. So this can be sort of the one-off thing. So, maybe one quarter you just make it clear, well, we're going to pay an extra dividend. Nothing out of the ordinary, but don't get used to this spending this extra dividend. We don't have enough projects to invest in, so rather than sit on a bunch of cash, we're going to give some of this back to you. And so, this can come and go, but I don't think there's a lot of extra dividends. I think generally it's either a special dividend or a regular dividend. So special dividend, you make a big announcement, and I think Microsoft, when they paid their first dividend, or once they started, and this was way back when I had hair, that or more hair, I guess. Anyway, they made a big deal of this. It was like $10 there, and people were going wild. And if you own Microsoft stock, and you got this big dividend check, but they made it pretty clear, this is a one-off, this is a one-time thing. Don't get used to it. And now they're paying a regular dividend. Liquidating dividends. So, I guess you hope you don't experience that firsthand. You could just, the business could just wind down, and, they decide, we're calling it quits and paying off our liabilities, and hey, there's some money left. We're just going to give it to the shareholders because it's their money. And I wouldn't say that's a common occurrence either, but, it could happen. It usually, more likely, is they'll go bankrupt and you won't get anything. So But I guess there's always the chance that they just decide to call it a day and give you your money back. All right, so some key dates. So on your counting days, you probably are familiar with these 3 dates. So declaration date, well, that was the board declared it. That creates a liability for the company. So now they're obligated to pay that dividend. Of course, they don't have to declare a dividend. The date of record doesn't really impact accounting other than we have to know who gets the money. So the Treasury Department needs to know where to send the check. So whoever owns the stock on that date gets the check. So, and date of payment, of course, the checks are mailed or the deposits are made into the investors' accounts. Okay. The one we're going to, and you may not be as familiar with, is the ex-dividend date. So this occurs 2 business days before the date of record. If you buy a stock on or after this date, you will not receive a dividend. So it takes time to transition ownership. So they're saying 2 business days. And so as soon as it goes ex-dividend, then whoever buys the share after that doesn't get the dividend. Whoever owned it up to that date receives the dividend. And the stock price generally drops by the amount of the dividend once it goes ex-dividend. So just a timeline here, and again, you should know this, be comfortable with this, the ex-dividend date, and as opposed to the record date. So you've got 2, assuming this is a Friday and a business day, and the ex-dividend date 2 days before that, and then the other 2 dates are just the declaration date, and there's usually a fair bit of time between these dates on either end. I guess this is about a month. And so usually at the midpoint, record doesn't have to be, but the record date, and then 2 business days before that is the ex-dividend date. And what do we expect to see with the common, or the price of the share rather, trading on an exchange? Well, as soon as it goes ex-dividend, we expect it to drop by the amount of that dividend. Doesn't usually be, not always exactly that, like that, but it's pretty close to that. You should see some drop off pretty close to the amount of the dividend. Okay, theoretically that's what should happen, and not always, but it's pretty close to that. And I guess sometimes people get a little excited, the dividend's consistent, they got another dividend, they go out and buy more shares or something, but really nothing has changed. The share price drops, the shareholder gets some money back. Okay, so there's a couple of points of view out there, and in financial theory, well, the dividends really don't matter. I mean, you get a dividend, or the company keeps it and invests it. Well, you're good either way. But does dividend policy matter? And again, generally it does. I mean, we'll talk about a few reasons why. Like I say, you may. We'll look at some examples in a minute, but really what they're saying is, well, whether you get a dividend or or the company reinvests the money in the company and earns a return, well, if they can earn a better return than you're probably better off to let them keep doing what they're doing, right? So that's the example. I won't go through it here. Another way is to deal with this is homemade dividends. Let's say you really like Google or Amazon, and you got piles of money to buy shares with. I mean, I don't know what they're at now, $3,000 a share, and Google's over 2,000. So if you're going to buy 100 shares, you need a bit of cash. But anyway, you don't have to buy 100, but you decide, well, I really don't like Google, but they don't pay a dividend, and what can I do about that? Well, you can still buy Google, and instead of and there is ways to trade fractionally now. There's some funds that allow you to trade fractions of shares. But the gist of it is, well, if they're not going to pay a dividend, their price goes up, and eventually I'm going to sell 1 share, and I'm going to have my homemade dividend, right? So I need the cash every now and then, so I'm going to create a homemade dividend. All right, so who would be interested in low payouts? Well, so you're not as concerned about a big payout. When we talk about payout, we're talking about the retention rate, the dividend payout rate out of earnings. And so why might a lower rate be desirable? Well, if you're in, like again, if you're in a higher tax bracket, um, capital gains usually are taxed less than dividend income, and dividend income is taxed at a lower rate than interest income. So again, you might have a preference for, you know what, I don't need the cash. I just like the company to keep using it and growing it. I'll take my capital gain. I'll take it at a time that suits me. Okay. Flotation costs. So the concern we talked about flotation costs in chapter 15. So the idea is, you know, you paid out too much in dividends, and now we got to raise more money again, and you got all those flotation costs and issuing costs to deal with. Dividend restrictions. So you could have bond debt covenants in your agreement that say, well, you know what, if your debt to equity falls below this, you can't pay out dividends, or some other thing, your equity falls below a certain point, you're not allowed to pay out dividends. Okay, oops, I jumped the gun there. So if you don't pay out dividends, well, what can you do with the money? Well, you hopefully you have some investment opportunities. We know what our weighted average cost of capital is. We'd like to deploy money in projects that's going to generate a return above that, or at least equal to that. And so that's one option. We can take our cash and continue to invest it in our business. Or we can do what a lot of companies do. We can go in the open market, repurchase shares, and so there's fewer shares outstanding, and of course the demand will maintain or drive up the price, but then your earnings per share will increase because you got fewer shares outstanding, assuming your income has remained the same. We can look at acquisitions. We can acquire other companies. We talk a little bit about mergers. We don't really get into the detail of it. If you're interested in it, you can take advanced corporate finance, or there's probably, you know, beyond that, you can probably take a whole course on mergers and acquisitions. And you can purchase financial assets, which I don't know that's particularly exciting. So the company takes cash, invests in treasury bills or bonds, and you know, well, why not give the money to you and you can do that yourself? But anyway, I don't know that they'd be any better at it than you would be. All right, so high payout, please. So again, think of grandma. She's, you know, she needs that money to go down to, well, once she's down south again, or maybe she is down south. But anyway, you know, if you're going to Arizona for the winter, well, you need some extra cash. Or, you know, you got to pay your rent and your living expenses, and your pension doesn't quite cut it, so you're counting on that regular income. So again, you're in probably in a lower tax bracket. You're retired. You don't have a high employment income anymore, so you're relying on pensions and investment income. And so you're certainly interested in getting some money today, as opposed to, you know, waiting for that day when you cash in on your, you know, selling your shares and getting a capital gain. Sort of the bird in the hand argument. You know what? I'd rather have the cash today than the potential of more cash tomorrow. Taxes muddy the waters a bit here. So again, dividend companies pay tax on dividends, and then they pay dividends out of that after-tax income, and then the shareholder receives that. They pay tax on the dividend. There's the dividend tax credit, which tries to offset some of that inequity, but again, that's an issue. Some other companies don't pay tax on dividends, and then, you know, endowments and things like that are exempt from tax. A charity, they can make investments and they don't generally pay tax on those earnings. So that's the argument for the high payout. The next thing is signal. Oops, we got a lot of slides here with not too much on each one. Dividends and signals. So the idea that you're asymmetric information. So usually managers know more about the business and the health of the company than the outsiders, right? They're in there day to day. They know all the deals with customers. They know what orders have been written. They know what orders have been canceled. And so the idea is if management all of a sudden changes their dividend policy, whether they increase it or decrease it, that conveys a message to investors, good or bad, right? But asymmetric information just means that the managers know more about the business than the shareholders, in a large company. Okay, so dividend increases, well, that sends the message that, management's pretty comfortable in sustaining those earnings. They're not concerned about cash flow. Uh, if they have slight increases every year in dividends, they're sending a positive message, right? Um, People get to expect that signal of a healthy growing firm. And on the other end of that, well, dividend decreases or you just cut the dividend altogether. Management's concerned about its ability to sustain it, so they're concerned about cash flow, their earnings, um, expectations of a lower dividend indefinitely. And if you're using the dividend growth model, all of a sudden your dividend gets cut. Well, you know what that's going to do to your share price. Okay, and not always. I mean, worst case signal of financial difficulty. I mean, General Electric eliminated their dividend, and they're running out of, well, not running out of cash, but getting low on cash, I guess. And so again, they're trying to recover and turn things around there, so they may reinstate it at some point. And I don't know if they eliminated it, but they certainly slashed. Okay. Clientele effect. So this is um, the idea again that you have certain groups prefer certain dividend policies. So grandma and grandpa over here, well, they'd like some income, they'd like dividend. And then we have another person here, they're 35 years old, they're uh, sort of got their career on track, they're making pretty good money now, and so they're starting to save, and they just want to have a good return, invest this money, and not concerned about receiving any cash today. Okay. So the idea here then again is, you're going to have certain people, retired people looking for regular income, you buy telecoms, banks, companies that are going to pay a stable, uh, continual dividend with modest growth. Okay, again, if you're looking for a big return, you're going to go out and buy um, Google and Amazon. You're going to look for that capital appreciation. So again, the clientele effect. I mean, if you change dividend policy, well, you may all of a sudden lose shareholders and may attract other shareholders. So grandma and grandpa sell their shares, and then our young career professional that's 35 years old, they buy those shares up because they're not paying a dividend because they're short of cash. They're saying, you know what, we got so much opportunity, our future's so bright, we just have so many opportunities, we're just not going to quit paying dividends and invest in our growing business. These are dividend yields, and I appreciate it's not, I don't know what the date, I guess 2015, so that's, certainly wouldn't say it's current, but it's probably hasn't changed drastically. A few of these might have dropped off the list, but the banks are pretty steady in terms of slow, steady dividend growth. You're seeing dividend yield here around 4%. Um, Oil companies maybe have dropped off. Valiant Pharmaceuticals, I don't even know if they're around anymore. Enbridge, so you got pipelines, BCE, so telecoms, and then insurance companies, and Husky, I guess, well, they're off the list now. So anyway, again, if you go into Yahoo or somewhere, you'll see the dividend yield. So that's what the dividend is divided by the share price. We've done that before, right, with our formula. Residual dividend policy, and this probably has more, this probably makes a lot of sense, but it's probably more appropriate for a private company. So everybody that's shareholders is involved in the business in the day-to-day. They work there, they're managers, they're owner managers. And so basically the residual dividend is, well, okay, well, let's see what our earnings are going to be. We're going to invest in capital projects. We have a certain capital structure we want to keep. And so basically, once we've decided all that, whatever's left, hey, we're just going to pay that out in dividends. So going to be fairly erratic. Well, it could be fairly erratic in terms of earnings, or in terms of dividend, rather. I mean, if your earnings fluctuate, your dividend's going to fluctuate. And so the idea here is, well, you know what? We'll just look at our earnings. We'll see what we're going to invest in new projects. We'll have a buffer for working capital, and hey, the rest of it, we're just going to pay out. Okay, so that's the residual. And I don't know that, well, we'll look at this example. It doesn't hurt. We got a debt to equity ratio here, so that's always good practice. We got 5 million in new investments. We have a target capital structure of 2 to 3, right? Net income of 4 million, and so 40% is financed by debt and 60% with equity. And how did we get that? Well, we take our 2 and add it to the denominator. So I get 2 out of 5. So I take the 2 plus 3. Remember, this is a ratio. We want a percentage, so take the 2/5, and that's 40%. And so 60% is the equity. So anyway, that's just a good practice on, again, the tendency to look at debt to equity 2/3. Well, that's 66%. So don't do that. Okay. All right. Well, anyway, let's see what else. Net income is 4 million. Equity financing's 3 million. 1 million paid out as dividends. So I guess just in other words, to maintain their equity financing, net income is 4 million. So they're just saying, well, to keep our ratio in line, we're going to pay out 1 million paid out as dividends, 3 million to continue to maintain our capital structure. Compromise. So companies in general are going to look at these things when they're talking about dividends. So, we hate to give up good projects. We don't want to avoid it. We want to avoid having to say no to those positive NPV projects because we paid out too much in dividends. The other side of that, well, we don't want to come and have to announce a dividend cut. We don't want to have to issue more equity because we paid too much in dividends. And the idea to keep target debt to equity and payout ratios, right? So our investors will get used to, if we're paying out 20, 30% of our earnings as dividends, that's our payout ratio. And so they'll get accustomed to seeing something like that, right? All right. So this is just the ranking of, and I think this, just for interest's sake, it's worth looking at this. So factors influencing dividend policy, well, stability of earnings, that's up there at number 1. As are the pattern of past dividends. So those are tied for top spot. And then next on the list, level of current earnings, and then level of expected future earnings, and then finally, desire to pay out in the long term, a fraction of earnings. So I guess that's made the cut. A manager's opinions on dividend policy. So again, I guess you can have a look at these. And I don't know, it's just a survey they did, I guess, but it looks like the vast majority feel that a firm should avoid increasing its regular dividend if it expects to reverse the dividend. Well, I think that's probably good advice for managers. Don't increase the dividend and knowing that you're going to have to cut it in a couple of years. Okay, and the rest I think you can read on your own. All right, well, let's look at a stock repurchase. So there's a bit of terminology in here. Stock repurchase, the company just goes and one of two options. They can make a tender offer and say, well, you know what, we're going to buy this many shares at this price, and that can happen. They'll usually go to existing shareholders and say, you know what, would you be interested in selling your shares? And it's usually above some current market price. I think Power Financial did that uh, 6 months ago or whatever, and everything was tanking in the market, and theirs was just holding steady. And the reason it wasn't going down is they'd tendered a repurchase offer for at that price. So you know what, if you can sell it for that, that's the price, right? Open market, I think that's probably more common. So hey, you know what, Apple got all this cash laying around and they ran out of things to spend it on, so they're going to just go up and buy shares in the market, cancel those shares, so you got fewer shares outstanding. They got rid of some cash, and earnings per share are going to go up, although that's a bit of an illusion. There's the same earnings, just fewer shareholders. It is similar to cash dividend when I take out those transaction costs and taxes, and can be an argument for dividend irrelevance. Well, in the real world, we have the Income Tax Act and all those other nasty things, commissions and things, transaction fees. We have to deal with all that. So, um, but in terms of taxes, I mean, dividends. If you sell your shares, you have the capital gain, if assuming you made money on it, hopefully, and I wouldn't worry too much about stock repurchases over dividends, or the Income Tax Act on a deemed dividend. I don't think I would lose any sleep over this. If you're an accountant and you're doing tax in a private company, then that's maybe more of a concern. Okay, well, what's again like a dividend, a stock repurchase sends a positive message, or it can send a positive message. Um, It may send a message, one, that the shares management thinks the shares are undervalued, so they're going out and buying them, and maybe that's a good thing. And hopefully they're not buying them if they think they're overvalued. That would be not counterproductive. Tender offers send a more positive signal to the open market because they stated a specific price. So Power Financial, you know what, we're going to pay everybody $33 per share, and we're going to buy, a fairly significant number of shares, so our share price isn't going to go below 33 for a while. Okay. And again, that message, they announce a share repurchase, that tends to drive up the share price. All right, well, let's look at stock dividends. So you'll probably recall from financial accounting, or maybe you don't, but you did at some point, you would have looked at a stock dividend. Instead of getting a cash dividend, the company gave you um, an extra, you own 100 shares and they gave you an extra 10 shares. And you think, hey, I got something, feel better already. And then you realize, well, you know what, the price just went down on those shares because they got more shares outstanding, and really I'm the same as I was yesterday, but I have 110 shares now worth the 100 that I owned yesterday, essentially. Stock splits are a little different beast. These are the company has a sort of a clientele, average investor, and their share price gets too high, they decide to do a stock split. So a 2-for-1, 3-for-1. I think Apple's did a 5 or 6-for-1 about a year ago. So, their stock was up at $600-700. Now they're down around 100. So they did a stock split, attract the smaller investor. So that's telecom companies do it. Banks like to do it. Well, don't like to, but they do it because the small investor, the share gets to be over $100 a share. The idea that the average investor doesn't have that much money to spend if you want to buy 100 shares, an even lot. So they do a stock split, essentially double. If it's a 2-for-1, they double the shares outstanding. So you got twice as many shares worth half as much. But for new investors, it makes it more attractive now to purchase those shares. And it's seen as a positive. company does a stock split. Hey, they're doing good. Those share prices have gone up enough. They have to split the shares. Of course, if you don't know about the stock split and you look at the price and it's dropped in half and you think, oh my God, what happened to my investment? First thing I'd check is see if there's a stock split. Assuming nothing else terrible happened in the world or to that particular company. All right, quick quiz. Well, we'll do a few problems here, and before we go today, we still got a fair chunk of time, so we'll do a few problems, and I think we'll actually get a chance to start chapter 18. And I know you're happy to hear that. Okay, so we're not going to do a whole bunch of problems, but let's do a few problems here from the book. So we're chapter 17. I'll bring up our, let's go to the next page here. Okay, so it looks like page 701. I'll start there. And we're going to look at question 4 here. So we're just going to look at stock splits. So give you a minute just to read it, and then we'll have a look at it. Okay, well, let's have a look at this. So we're looking at stock splits, and I expect you probably haven't done these in a little while. So assuming a perfect world, no market imperfections or tax effects exist, what will the share price be after the following? Okay, so they currently have 425,000 shares outstanding. Current market price $80 a share. Yes, we all do. Yes, that's for sure. I guess it would be boring though if it was perfect, right? Okay, well, let's look at this. 699, I guess. Well, just over the page to 700. So question 4. I'll put, I don't know where the cut is there, but I think 699 to 700. I think we've narrowed it down to that. Okay, so we have 425,000 shares, and they're trading at $80 a share. I don't know if that would really matter. Well, I guess that does. Depends on the question, I guess. So I guess let's read the question. Determine the new number of shares outstanding in parts A through D. All right, so Mill Creek Corporation has a 5-for-3 stock split. Okay, so 5-for-3. Better not do it that way. So what does that mean? Okay, so in other words, if you got 3 shares, they're going to give you 5. So you give them 3, they'll give you 5 back. Okay, so that's your traditional split. You're going to reduce the amount of the share price, so you're going to multiply by 3/5. So the $80 times the 3/5, so we've now got more shares outstanding. You had 3, you now got 5. If you had 300, you now have 500, and so on. So if we multiply this out, we end up with $48 a share, right? So that's our new price. And with number of shares outstanding. Okay, so how many shares outstanding? Well, we had 425, right? So we did a 5 for 3. And so multiply by 5, divide by 3, and we should have 708,333.33. So I would just say 4. Like I say, it is possible to do fractions of shares in bigger companies. There's funds that'll do that, but I guess we'll just assume that we're still dealing with whole units for shares. All right, what's the next one? 15% stock dividend. All right, so what happens there? Well, you got 15% more shares outstanding. So 1.15, we're going to divide. And I think we get 69.56. Okay, so how many shares will be outstanding now? Just remember that we're always going back to this initial amount. So each one of these is independent, I guess. Okay, well, we should have 15% more. So if we multiply that by 1.15, we get 488,750. All right, I'll give you a few minutes to try the next one. So can't say I've seen this happen very often, a 42.5% stock split, but just follow the same method and what's going to happen. So this is A, B, C. Okay, so we have a 42.5% stock dividends. I think that's what it said. I'll give you a minute. So what's the new price per share and what's the number of shares outstanding? I'll give you a couple of minutes. Okay. Okay, Joy Marie, I'm not looking at your number and maybe you jumped ahead. I'm not sure what that is. Or you got 570.36. So let's see what we get here. So we're basically going to divide this by 1.425. same approach, divide this by 1.45, so it's going to be lower, right? Yeah, so it's going to drop in price. There's more stock outstanding, so 56.14. Okay. And then how many shares are going to be outstanding? Okay, well, you got 425, so you're going to have another 42.5%, so 1.425 times the 425. So again, just make sure you're going back to the original scenario, so they're not cumulative. They're everyone starts from the beginning. Okay, so yeah, it's not like it's you go back to the beginning, hit reset, and then start the next one, and then so each of these are independent, and so they're not cumulative. They're not related to each other, so that might be part of the problem. Okay, so how many shares? 605, 625. Okay, oops. Now just got that. Oh, that's not dollars, that's shares. So keep that straight. All right, let's look at D. And what have we got for D? A 4-for-7 reverse stock split. Yeah, well, it's easy to get in the habit. So yeah, when you got units and shares and dollars, but yeah, I'm gonna make sure we keep it straight. So a 4-for-7 reverse split. I guess I don't have to write the. So a reverse split, well, you got 7. You give me back your 7. I'm gonna give you 4 back, and you might think, well, that doesn't sound like a great deal. Why would a company want to be doing a reverse split? Well, generally, it's not a good reason. It's think of a gold mining company. They think their shares have dropped to the point where they're trading at fractions of a cent, and they want to get it back. Yeah, they want to drive the price up. Um, and I guess it's not impossible. Someone was saying, well, General Electric should do a reverse split, and a lot of people say, well, that makes no sense, right? But so what they're saying is, well, you know what? You're gonna give us 7. We're gonna give you back 4, so that the ratio is, well, it's 7/4. And I think I saw a few answers here. 140 is correct. So yeah, that's the price. All right. So and like I say, a mining stock or resource company, it's not quite bankrupt, but getting there. Shares are trading at fractions of a cent, and they want something a little more meaningful, so they do a reverse split, and usually it wouldn't be 4-for-7. It might be, for every 10 we'll give you 1 for 10 or 1 for 20, and they're just trying to get the share price up to a more meaningful trading value, which generally, as you might guess, is not a great spot to be in. All right, but let's see how many shares we have outstanding here. So we started with 425, just multiply by 7, divide by 4, and that should give us our answer, right? Yes. Okay. Sorry, we should. Pretty sure I did that backwards. 425. Yeah, well, it's reverse split. Well, you got to reverse the numbers, right? So we're going to have fewer outstanding. So if we know we need a number smaller than 425, right? Yeah, so 242, 857 is correct. Okay. So like I say, it's always a good idea to, well, what's happening? We're going to have more or less. And if we're not sure what to do, then at least we know we can narrow it down. It has to be less than that, right? Yeah, no, I think I did too. And then I looked and well, that doesn't look right. So anyway, I mean, normally you're going to be doing a standard split, right? Reverse splits, as I say, they're not very common, and that's probably a good thing that they're not. Okay. All right, well, let's look at, maybe we won't get into the next chapter, but the next few will go pretty quickly, so we'll see where we end up here. But this is, we are going to do more problems, but this is your last one with, chapter 17 is the last one with an assignment, so we want to do a few here anyway. All right, well, let's look at question number 5. Uh, so we have a statement of financial position, known as a balance sheet as well. Um, Note that it's in market value terms. I want to look at number 2 as well. Oh, I suppose we could do that. Okay. All right, well, let's look at, we'll come back, look at 2. So 5, we have regular dividends. So this is the idea, and note it's market value. So the idea with market value, as opposed to book value, well, we've adjusted everything. So fixed assets are at market. Cash is, well, cash is cash. It's always using a market value instead of a book value. Okay, so the company's declared $1.30 per share dividend. The stock goes ex dividend tomorrow, ignoring tax effects. What is the stock selling for today? What will it sell for tomorrow? And what will the statement of financial position look like after the dividends are paid? Okay, so we got 12,000 shares outstanding, so we can figure out we know the number of shares, we know the dividends $1.30. And so give me a couple of minutes to look at this one. And we'll look at 2 after this one. Still should be okay for time. Okay, let's have a look at this question 5. So keep in mind we have market values here. So the 387,900, that's the market value. Okay, so we have current market capitalization, so the entire equity value of the company, 387,900, and we have 12,000 shares outstanding. Okay, and what do we want to do here? Stock goes ex-dividend tomorrow, ignoring tax effects. What's the stock selling for today? What will it sell for tomorrow? Okay. While the current market value per share, if we take the total market cap divided by the shares outstanding, we get a value of $32.325. So I'm just going to use 3 decimals here, just because I think eventually it just balances a little better when we try and do this. Is the short answer. And you could get you could get a quarter-cent dividend, I guess, in theory, or a fractional dividend, not unusual. That's the share price. So used to trade in fractions like sixths or eighths, and now it's decimal format. Now that we have better computers. Okay, so ex-dividend price. Well, this is what it's got to be worth right now, right? That's the market value today. So ex-dividend, what's going to happen? Well, it's going to drop by the amount of the dividend, right? So 32.325 minus the $1.30 dividend. So the ex-dividend without a dividend should be 31.025. Okay. And the question is, well, okay, well, now what's going to happen to equity? Let's see what happened here. We got, sorry, 12, did I say 12,000 shares, hopefully? Yeah, okay. So 12,000 shares. And we paid $1.30 dividend. That's $15,600. So what's going to happen to the statement of financial position or our balance sheet? Well, cash is going to go down by 15,600, and equity, retained earnings, it's going to decrease by this 15,600. Keep in mind this is market value financial statements. So finance, we focus on market value as opposed to accounting and book value. Okay, so yeah, it's going to drop. Cash goes down, equity is going to go down. Okay, well, let's look at this next problem. I know that I think this is one of those that for being question 2, it's a little bit obtuse, maybe is a word that could be used. But anyway, let's have a look at it. Owner's equity section for Okanagan International shown below. Common stock, dollar par value. So in other words, if it's $1, we must have 40,000 shares outstanding. We have a capital surplus account, and we have retained earnings. So generally, you don't always have a capital surplus account, but anyway, we do in this particular case. So what happens if Okanagan stock currently sells for $30 per share and a 10% stock dividend is declared? How many new shares will be distributed? And show how the equity accounts would change. And part B, if Okanagan declared a 25% stock dividend, how would the accounts change? Okay. So I'll give you a minute to look at this, and let's see what we can do with it. Yeah, now we got 4,000 new shares, right? That looks good. Okay, let's have a look here. Okay, so based on the information we have, we know that we have 40,000 shares outstanding. And how do we know that? Well, the common share count has a dollar par value, and there's $40,000 in the common share account. We have a capital surplus, so whatever shareholders pay above a dollar par value goes into the capital surplus account, and not the accounting you're probably used to, but anyway, that's what we got here. And then retained earnings, well, that's retained earnings. Okay, well, let's see how we got that. So we had a 10% stock dividend, right? And how many new shares will be distributed? Show how the equity accounts would change. Okay, let's see what we got there. Okay, where did I get? I forgot to keep writing zeros there, didn't I? Okay, so 40,000 shares, dollar par value. Okay, and did a 10% stock dividend. Okay, so what's going to happen? Well, we're going to have 10% more shares, or 4,000 new shares, right? Okay. All right, so in other words, we now have 44,000 shares outstanding. Okay. And then we want to know what's going to happen with the equity accounts once we do that. So the shares are currently selling for $30 per share. Okay, so we just announced a 10% stock dividend. Okay, so what do we expect to happen? Well, we would expect then the capital surplus account to drop by $1, right? So if they're currently trading at $30, we've issued 10% more. So we'd expect the price to drop by the par, or the capital surplus account to drop by $1. So we at $29, okay? So if the capital, we have nothing's changed in equity, but the capital stock account's gone up by 4,000 shares, so $4,000. So we're going to have a dollar drop in the value of our capital surplus account, in other words. Okay. Or rather, the new shares rather will be at a $29 capital surplus. I guess that's a better way to say it, or maybe less confusing. So we've got 4,000 new shares at a dollar par, and then we're going to have 4,000 capital surplus at 29, right? So that's what all we're trying to say here. So it was 30. So if we $1 par, so that leaves 29 for the capital account. So we have 29,000. Or 200. Sorry. So $4,000 par. Okay, let's, I think we got, know what we're doing now. I think I was looking at the wrong. So we got the 4,000 increase. So plus the current 40,000. So we're now at 44,000, right? That's our common share account. The capital account is going to increase by 4,000 times 29. So that's going to go up by 116,000. Okay. So we need to add that to what we had here before. So we had 345, and then we need to add the 116 to that. Oops, I'm getting carried away here. 345 plus the 116. So that should give us 461. Okay. And we know that in total, well, nothing has changed, so the equity is still 1,113 or 133, sorry. So essentially, retained earnings becomes the plug number. Because nothing has changed in terms of value, just the capital. We gave away, we didn't give away, well, I guess we did. We declared a stock dividend, so we have 4,000 new shares at $1, so they were at 30, so the other at $29 on the 4,000. So we're adding that to the capital surplus account, and then the number here to continue to balance, right, is the 628, I believe. $628,900, right? Yeah, I guess that makes sense. Okay, so basically, I don't know, it's not a particularly useful question, but I think anyway, I think it's on your assignment. So anyway, maybe that's one to take off. But the idea then is, okay, well, you got the par value, so that increases. And yeah, it is on the assignment. Okay, well, probably a good one to change out then. And then, so you're going to have the other 4,000 contributed surplus, well, that's at 29. And so you can figure out these two numbers. Equity hasn't changed. Yeah, well, I wouldn't, when you get a question like that, I would just wait till class and ask about it, and if you get stuck. So anyway, that's how we can do that one. And I think you can follow the same approach now for B. And now that you have a better idea of how to tackle that one, you think you'll be okay for B. All right. So I know we're a bit over time here. But I'll end there for today, and we'll jump into chapter 18. And if you have any questions on the meantime, let me know. So the quiz is available all day Thursday, so don't forget about that. All right, so I'll stop the recording here. I got a few minutes. I'll stick around here if there's questions. Okay, have a good rest of the day. Good rest